Mulligan. I'm Ben Calkins, and I am one of the founders of the Center for Free Enterprise, with David Brown to my right. Now, let me begin by introducing our sponsors briefly, and please be sure to patronize our sponsors. First, our newest, he's not a sponsor yet because he hasn't agreed to be, but he's here doing service, so we applaud that. And over here is Wyndham Ratchford with the camera. And Wyndham is the owner and creative director of Creative Gold Media. Let's give Wyndham a round of applause. And in theory, we're going to have videos of our presentations on our website. Now, our other sponsors, which I'd like to acknowledge, are our friends at J.P. Morgan, Ken Greeny and Greg Keegan. Are they here? Yeah. Okay, back here's Ken. In contact of Ken, there's got to be someone in the room that'll have a liquidity event soon. So keep Ken in mind on that happy day. And then another sponsor of ours is Mike Maimoni, who's not here today. Mike is a web guy who's originally from Ashtabula and works out of Chicago with MM Web, but you can contact Mike for your internet needs. David's one of our sponsors with Red Hawk Associates. Be sure to use them for your acquisition searches and other needs.
Again, welcome to the Center for Free Enterprise meeting, a discussion with Bill Mulligan. We're going to talk about private equity and venture capital and his career. I'd encourage everybody to jump in with questions. I've got a couple of icebreakers. I'm using a microphone just because we've got Wyndham and we'll pick up the sound a little bit better. So tell me if you can't hear me or if I'm too loud. I first met Bill 35 years ago, and I followed his career very closely since then. When we were doing our pre-call, I think last week or the week before, he asked me about the format and kind of what's the vibe in this group. And I said it's kind of like a cocktail party with no cocktails. It's before everybody is really awake. But we talk about business and deals and get to make some new friends and business acquaintances, and it's a fun way to spend an hour and a half 4 or 5 times a year. So hopefully you all agree. Chip in with, again, questions. Let me just introduce Bill and we'll get started. Bill attended Denison University and then University of Chicago for his MBA. He started his business career with Deere & Company, I believe. First Chicago, then Deere, and then McKinsey & Company, which is where I met Bill. And then he joined Primus in 1985. And Primus, as some of you may know, some of you may not have been born back in 1985. But Primus was partly a brainchild of an organization called Cleveland Tomorrow. And we'll talk a little bit about that. Bill is also very active in charitable areas. He's on the board of directors and board of trustees of the Western Reserve Land Conservancy and also of the Cleveland Clinic. So we'll talk a little bit about that. So welcome, Bill, and I'm glad you're here. So here's the first question. Are you ready?
I'm ready.
Why in 1985 did you decide to join Primus?
I was with McKinsey. Can you hear me?
You have to hold it closer.
I was with McKinsey, the Cleveland office, and I had just recently done a study for General Electric where we were looking at developing a new technology, and it was kind of a startup business plan that we worked on. But at the same time that I was in the middle of that study, I ran into Loyal Wilson, who was here from First Chicago and had just landed in Cleveland to start Primus Capital. Actually, at the time, it was called Primus Venture Partners. He had the backing, as David noted, of the Cleveland Tomorrow companies. It was a group of approximately 35 of the largest publicly traded companies. The CEOs were all members. They came together working with George Voinovich to get Cleveland back on its feet. This was the early, I guess, 1983, 84. Loyal arrived in late 84. And I happened to run into Loyal on Concourse C at the airport. We knew each other from First Chicago. I didn't realize he had come to Cleveland, and we began a conversation thereafter about Primus, which was essentially one person. The fund had not been raised. It subsequently was raised, $10 million from these 35 companies, and I think most of the money came out of their philanthropic pocket. I think they wrote off the investment, if they deemed it like that, the moment they made it. We married that $10 million with $20 million of commitments from the state of Ohio pension funds, the 4 large pension funds. We were the first private equity or alternative investment ever made by all 4 funds. They now have multi-billion-dollar private equity portfolios. But Loyal and I started a conversation in March of 1985. Those conversations got a bit more serious. Actually, Loyal had hired someone from the West Coast to come out as a second partner. And that person had accepted the job, moving from Los Angeles with his wife. He went back to his wife and said, "Honey, I just accepted a job, we're going to move to Cleveland." She said no, so he didn't come. And that opened the door for a conversation with me in March of 1985, and in July of 1985 I joined Primus. We were a startup fund. The fund had just been raised, and we were going to go out and make our build an investment portfolio. And we were limited at the time to Ohio investing, and that was a requirement by the state funds. That was an 18-month requirement, and we invested the $30 million, and we've raised 7 funds since. We're currently raising Primus, or investing in Primus 8, where we're probably 40% committed. It's a $540 million fund. In today's, the $30 million fund was considered a mid-sized fund in 1985. We're a $540 million fund, and we're considered a small fund in today's environment.
So we were talking a little bit before we kicked off formally today, and you were telling me a little bit about your investment criteria out of Primus 1 compared to Primus 8. Can you share that with the audience?
As I mentioned, Primus at the time I joined was called Primus Venture Partners. We were doing really the full range of private equity investing. We were doing early stage company startups and everything to later stage buyouts. So we were somewhat stage agnostic. We were industry agnostic. We were geographically focused, principally Ohio and the Midwest. Today, it's very different. The name of the firm is now Primus Capital Fund because we've moved away from the early stage investing. We're still focused on growth companies, but we're looking at lower middle market growth companies. We define those as market enterprise values of $250 million and less. Principally $100 million and less. That's where we make most of our investments. So it's lower middle market, but growth. Our premise for building value is growth. So we're not value investors. We're not ones that try to financially engineer to an outcome. It's very much dependent upon businesses that are positioned to grow and double in size, triple in size over our hold period. And that's kind of the basic premise for our investment criteria. We have a sector focus. Healthcare has been an important sector for us. One of our most successful investments when we were doing early stages, Steris Corporation here in town. We were an early investor there in subsequent rounds and ultimately sold our position when it went public. And healthcare is an important sector for us. Technology, software is as well, tech-enabled services. And then we have particular verticals that we are focused on: education, healthcare IT, marketing services, financial technology, that are below those 3 major pillars of our strategy. We're also flexible in the way we invest. Probably a third of our investments are minority investments. 2/3 would be control investments. So we are pretty flexible on how we go to market, and if someone wants to do a minority recap or raise growth capital, we'll provide that. If someone is interested in selling their business and to a control buyer, we'll do that as well. So that's, I guess, the third pillar. And the fourth pillar is we're active investors. We go on the board. We typically have 2 people from Primus on every board, and we're very actively engaged in working with companies and hopefully helping them grow and build value.
So what was it like in 85, 86 to go to those 4 pension funds here in Ohio and really introduce the idea, I guess, of the type of investing that you and Loyal and I don't, if it was just the 2 of you at that time were planning to do?
Well, they didn't know private equity at the time. I mean, this was all new. And I think they looked at it not unlike the Cleveland Tomorrow companies, in that this was kind of an economic development play for them. You know, they were multi-billion-dollar pension funds. They're now, as an example, I think Ohio PERS is $80 billion in size and probably have a portfolio of private equity that is close to $10 billion or thereabouts. So we really had to educate them on what venture capital and private equity was. To be honest, they really didn't care, because it was kind of a mandate coming down from this group in Cleveland Tomorrow companies, to the governor and ultimately to the pension fund, saying, you know, this is something we ought to do. Again, we delivered great returns on that first fund. We gave them, you know, it was about a 2.1 net return to them, you know, a 20%, 25% rate of return, which is a lot better than they got elsewhere. Unexpected by then, I'm sure. But again, we had to educate them on what it was. To give you how it's transitioned, PERS, Ohio PERS, which made a $5 million commitment there first, we went to raise money in Primus 8 from them. They've been in every one of our funds. And they had to set up kind of a side pocket fund managed by a third party to do investments in funds where the check size for them was less than 200 million. So they were planning to put, you know, $2 billion to work 2 years ago, or I guess it was last year. And they were going to attempt to do that in 10 investments, average investment size of 200 million. And we were too small at 540 to qualify. So they set up another fund that will make investments of $10 to $20 million in smaller funds. But I think it highlights how, from the investor side, how things have changed over the last 35 years. When PERS was making their first investment of $5 million, they're now committing $2 billion a year, average check size of $200 million per fund.
Any questions so far? Shall I continue with my my dialogue here? So, I mean, the obvious question is, what's driven that growth? Is it the higher than, relatively higher returns that you get in private equity investing for Ohio PERS? And
well, as you all know, private equity has kind of exploded. When we raised our $30 million fund, as I mentioned, we were considered kind of a mid-sized fund. The same year we raised our fund, Bain went out for their first fund, and they raised $34 million. I could probably count on 2 hands the number of funds that were greater than 100 million in size. I mean, you had KKR was one, Clayton Dubilier may have been another, Warburg Pincus was another, but there weren't many funds over $100 million in size. Today there's thousands of them, it seems. And my son's with a firm that didn't exist back then, called Platinum Equity. They just went out and raised their 4th fund. I think it was $6.5 billion. So you had this development and maturing of the whole private equity market. Many of you are part of it. You've seen it. Tons of money has been raised, and I'm not just kind of chicken and the egg. I think there was nucleus of very successful private equity funds that delivered very attractive returns. That caused more investors to say we want in. That caused more people to raise funds. That caused more money to go in. And now it's I'm not sure what the uncommitted capital is, but it's measured in the hundreds of billions of dollars now in terms of money that is available to invest, and it's become an efficient market. It's become a very mature market, and one that has delivered, relative to other investment alternatives, whether it be fixed income or just a public equity stock portfolio, competitive returns. And you can get alpha through investing in alternatives, which many of these pension funds now do. It's an attractive option. The most endowments, most large pension funds will have a significant allocation to private equity. I'm involved with an endowment on the investment committee. It's an $850 million endowment, and it's got $20 million, or 20% rather, allocated to private equity. Turn back the clock 20 years, it was zero.
So, yes, sir.
So can you talk a little bit about the sort of the evolution from Fund 1 to Fund 8 in deployment of cash because of this huge explosion of competition, really?
Sure.
So repeat that question.
Well, he asked about the deployment, the contrast between Primus 1 and Primus 8 and the deployment of capital. Our $30 million fund, we had 25 investments. So we were a little over $1 million per investment. Primus 8, a $540 million fund, we're going to target 12 to 13 companies in that portfolio. So the average, or the target size for our investment, which would include follow-ons, is 40 million. So our average investment size in Primus 8 is larger than the entire fund in Primus 1. Again, we've transitioned out of early stage investing, so we're looking at later stage companies and looking at deploying most in controlled buyouts. So the check size would be larger, but that gives you some contrast. We put to work the 30 million in 25 companies over about a 4-year period, 5-year period. We hope to do the same in Primus 8. Although we're 18, 20 months into Primus 8, so we're fairly early in the fund life. We've already committed, actually invested close to 45% of that fund. We have under exclusivity 3 additional companies. I'm not sure we'll close all 3, but if we do, we'll be 70% committed in that fund, and we probably do that within a 2-year period. That's kind of unprecedented for us. Everybody talks about what is the market, is it competitive, everybody's bemoaning the fact that they can't put money to work. We've never been busier, and we're probably on an investment rate that will get us to full investment on that fund within probably certainly 3-year period, if not shorter. It's the pace has picked up for us. The average check size is 40x what we were investing in Primus 1, maybe a little less than that. Different profile of companies, and I think that's reflected in other funds that are raising capital. I mentioned the $6.5 billion fund. Many more transactions, a lot more money out there. I'm not telling this group anything you don't know, and very competitive.
Benjamin.
Bill, how has Primus evolved from, it'll give you a nice story to tell, I guess. How has it evolved from just you and Loyal 35 years ago to today? How many people, doing what, out of where, that type of thing? How has that changed?
As I mentioned, it was Loyal and myself back in 1985. We now have 21 people, so we're still relatively small. We are much more specialized in terms of deal teams. We have groups that focus on healthcare, financial technology, marketing services as an example, and other deal teams. So we have much more of an industry focus, building expertise, and also responsible for deal sourcing. That's a big difference. We also have an Atlanta office. We opened up an Atlanta office 6 years ago. We had one person that was had been working for Cox Enterprises in their kind of family office, private investing group. We hired him. He would not move to Cleveland, and we thought, let's plant a flag in Atlanta. We had done quite a bit in the Southeast. We have 2 companies in the portfolio right now in Atlanta. We have 3 in Nashville. We've invested in a company in Fort Lauderdale. So Southeast has been an important market for us. So we thought about opening the office. We actually have more people in Atlanta now than we have in Cleveland. We have 12 people in Atlanta. We have 9 in Cleveland. So a lot of the investment activity is being generated out of the Atlanta office. So I think in terms of contrast to where we were, Laurel and I were principally fielding investment opportunities across the stage of development, across industry, principally Midwest, a lot of inbound stuff. Today, it's very much we're out proactively looking for companies, touching companies, a year, maybe 2 years in advance of them running a process. So there's a lot more marketing for deal sourcing, more specialization from an investment team perspective, larger check size, larger organization. Atlanta's proven to be a great office for us, for recruiting. Cleveland has been a more challenging spot to recruit into, although we continue to do it. Certainly, transportation's a lot easier in Atlanta, and we're doing a lot in that market. So those are some contrasts between where we were and where we are.
Larry?
I wanted you to talk a little about how you decide when you've had enough with an investment. When is it time to get out of an investment? Also, how the funds close up. How many funds do you still have running continuously? And the changes in the way the public markets take an original venture capital investment today are quite different than you always used to make money when you went public back in the old days, right? Now, sometimes they don't.
Right. Well, the last point, we haven't taken a company public, I don't know how long. The last one that we took public, I bet it was 5-6 years ago, a company called IVP down in Columbus. That has not been our exit. Most of ours have been either selling to other private equity groups or to corporate buyers. Those have been the exits in the last 5 years. So we haven't tapped the public. That used to be the best way to maximize value. To your point, I'm not sure that it is now. I mean, we're getting public company valuations on sales, and we don't have lockups and all the other issues. In terms of how many funds we have Primus 7 is still active. We've got 5 companies in that portfolio. We've got a couple from Primus 6 that we're still nursing along and hopefully we'll have sold. And then we've got the portfolio at 7. We'll have most of 6 and 5 wrapped up, if not totally wrapped up, when we go out to raise Primus 9. And we'll have an active portfolio in Primus 7. In terms of how do we decide when to sell? I'll give you an example. We just sold a company that we had invested in about 4 years ago. It was a minority investment, and we had significant structure in the investment we made. It was a minimum return plus a dividend. And given the performance of the company, we concluded that we were never going to do better than the minimum return we had structured in the investment, which was 2 times our money for the first 3 years, and then thereafter 2.5 times our money plus, I think it was an 8% dividend or something like that. So over a 3 to 5 year hold, you could look at close to 3 times your money on the structure alone. If the company really performed, we would have converted our securities and taken the common stock value. We determined we were never going to be in the money on a converted basis. We could have held the company for 10 years and we would have never gotten there. So our conclusion was we ought to push for a sale today, take our minimum return, which wasn't bad, and move on, which is what we did. So, a company that's stalled, if you have a return that is acceptable, better to push it out, sell it, and return the money to the investors. We've also had situations where kind of unsolicited, the buyer will come in, and this has happened, I think, in several of our recent exits where we didn't have a process going, where someone wanted to buy us, kind of preempted a process, gave us a value that we thought was right, and we sold it. Typically, our hold period is 5 years. We'll sell earlier if we can, but that's typically what, the investment program is a 3 to 5 year investment program, 5 year average hold, 10-year fund. That's how we're structured.
So you said in '85 it was Primus. I think Bain had started a fund. There may be been 1 or 2 others. Bain, I think, Mitt Romney was involved in that one. So, some real pedigree there. And here we are 34, 35 years later. Primus 8, you're thinking about Primus 9. And there's now thousands of funds, private equity funds, billions and billions of capital. But there must be something unique about how you guys are evaluating your investments and how you're managing and building those companies and how you're exiting to be, still in business and so successful. So here's the question. Maybe just walk the audience through, if it's an example or just a hypothetical, what are you looking for today when you're deciding to make an investment? And what you said, it could be 5-year hold, it could be less than that. What are you trying to do in those 2 to 3 years to really try to create value?
Well, I don't think we have anything that's unique. I think the market is too competitive. I think in terms of why an investor is interested in Primus, and then maybe what we're interested in terms of companies. I think number one is if you deliver good returns, and I guess our target is at the portfolio level before fees and carried interest. We target in a fund a 25 to 30% rate of return. And we underwrite companies at the same level. So when we look at a company, we'll underwrite it to a kind of a 25 to 30% return, kind of a 3x on our money over a 5-year hold. And that's simply kind of the model. We look to limit losses to 10% of invested capital, and we hope to have a couple of breakout investments that would deliver, something, closer to 5 times our money. And that, at the portfolio level, is what we're targeting. At the limited partner or investor level, we want to deliver a minimum of 2 to 2.5 times their invested capital, and something approaching a 17 to 20% rate of return. If you do that, you'll raise a lot of money, I think so. That's been.
Sounds pretty easy.
It sounds pretty easy. It's as you all know, it's not all that easy. How do we do that? What kind of companies do we invest in? As I mentioned, we're looking for companies that a typical size company might be a $25 million business. We've done $100 million, $200 million companies. We've done things that are smaller. A $28 million business that is growing quickly, is undermanaged, perhaps undercapitalized, doesn't have an M&A program, hasn't built out the management team. but is serving a growth market with an established product and immature margins, and has a business model that with scale can disproportionately scale margins relative to revenue growth. So 10% revenue growth could deliver 20% types of contribution, and therefore you could really increase EBITDA over the whole period. And that's what we're looking for. So if we can find a company where we can grow it 2 to 3 times the size at time of investment, that has a business model with a ton of operating leverage, where we can add management, maybe a better strategy, improve sales and marketing, bring some capital to bear, maybe an M&A program, so we can take a company that's doing 20 million and grow it to 60 million, take margins that may be immature at 10% EBITDA margins, but at maturity it could be 25 to 30%. That's our model. And those are the companies we're looking for. We're very much industry focused now. We have companies in Fort Lauderdale, in Vancouver, in Los Angeles, in Boston, in Madison, Wisconsin, in Cleveland. In fact, 3 of our recent exits, recent being the last, I guess, 2 years, have been Cleveland companies: Cardinal Commerce, Exact Care, and PartSource. I think you'll hear from Ray Dalton at the next meeting, who was the founder and CEO of PartSource. That's what investors are looking for. In terms of what we're looking for at the kind of the investment level or company level, it's the profile I just described.
Yeah, Sean.
So it's always interesting to hear some success stories, and on the flip side, could you touch on some investments that may not have gone as well, and what you may have learned from those?
No.
Our success stories. It's a company that kind of performed like I just mentioned. We just sold a payment processing business that was headquartered in Seattle. We sold to Visa. And this was a company that profiled exactly as I outlined. I think we got in, it was probably less than $30 million in revenue. It was on a run rate of closer to 80 million when we sold it to Visa. They paid a multiple of revenues, great outcome for everyone. Not all investments work out that way. In Primus 1, when we were doing venture, even through Primus 3, we had a portfolio that was driven by a few outsized winners. And that's kind of the venture portfolio, because we were probably more venture oriented than we were private equity. And we had a significantly higher loss rate. Companies that the early stage companies that just didn't get traction and ultimately failed. We elected not to continue to invest them, and they failed. And we would get a handful of companies that would deliver 5 to 10 times our money, and the portfolio would deliver competitive returns to our investors. Today it's very different. I mentioned in Primus, I mentioned our criteria, less than 10% of invested capital that we would lose. In Primus 7, we've had no companies that will deliver less than cost. In fact, we will have all of the companies deliver more than cost across a portfolio of 12 companies. So we are very focused on loss rate and preventing losses. That isn't to say that all companies perform. I mentioned the business that we sold. This was a company that in the marketing technology area, headquartered in California, that just stalled in terms of growth. We had significant customer churn. We had management turmoil. We had a whole bunch of issues that we were sorting through. Maybe we should have seen that in advance. We probably, as we look back and looked at the dynamic within the management team, there were issues that were evident when we were making the investment. The customer churn was a surprise. That was kind of a competitive issue. The market just became a lot more competitive as during our hold period, and we elected to sell it. Luckily, we were a minority investor in the deal, and we had a significant amount of structure around our security, so we came out just fine. But we came out less than what we had hoped to achieve in terms of the investment. You know, there's a thousand reasons why companies don't perform. I guess the one thing that has changed for us is that we always felt that the number one ingredient to a successful investment in Primus One, the OT, was the management team. And these were early stage companies, and it was just critical that we had a management team that worked. Today, management is important, but if we're in a controlled position, if we don't have the right management, we can change it. If we have the wrong product or the wrong market, the wrong competitive dynamic, those are things we can't change. We got to get that right. Now, that isn't to say that we're indifferent to the quality of the team. We're not. We very much want to back the team that's there. But in Primus 7, in 50% of the time, we changed out the CEO. In 90% of the time, we changed out the sales and marketing head. And almost in 80% of the time, we changed out the CFO. So if we have a company that's stalled, you know, we will step in and change management. And that's been a real transition for us. Again, management was kind of the number one element that would cause us to want to make an investment in Primus, the early funds. We're doing earlier stage investing. Today, it's important but not critical because we can change it.
Yeah, I mean, that does sound like a big change, and maybe elaborate on that. Does your industry focus? You said, I think that you're more focused on certain industries now. Does that help you in the identification of a replacement CEO, CFO, sales and marketing guy, because you're more familiar with kind of the terrain in which that company is operating?
I think so. I mean, yes, the answer to that is yes. I mean, the deep industry expertise that I think we've developed, you know, allows us to know who's in that market. You know, we may elect to hire someone for due diligence, and we've done this several times. Someone within our network to come in and help us diligence an investment. Ultimately, that individual will step in and serve some sort of management role in the company in which we invest. Today, I don't know how you are successful in private equity, at least, and even venture, without a degree of industry expertise. It's just too competitive. I mean, you need to, on the sourcing side, you've got to be in the flow. You've got to know what companies are out there, what companies are attractive. And we don't have kind of a bullpen of people doing outbound calling. We have deal teams, and each one of the deal teams, and the partner in particular, is responsible for sourcing. So within healthcare IT, we have a team of 3 people. They are focused exclusively on that market. They know it well, and they're responsible for sourcing. That only helps in sourcing, because we're identifying the emerging companies, the companies that are attractive. You know, we are within the network of investment banks, many of you, and they know that we're interested in a certain type of company in a certain industry, so we're in the deal flow there. And then in underwriting, unless you have an understanding of the market, and particularly for us where we're underwriting growth companies, I mean, how do we grow these businesses? Unless you have an understanding of the market dynamic, you can't underwrite.
Right.
And, you know, we're underwriting many companies as a multiple of revenue, not a multiple of EBITDA. And they're immature margins, you can't do that. This is not, you know, slapping 8 times or 6 times on trailing EBITDA and that's your value. What we're looking at is what the company can grow into, and take a revenue multiple and have you know, what would it look like on a reasonable exit on a multiple of EBITDA. That's kind of our play. And without an industry focus and an expertise, I don't know how you underwrite the kind of companies we invest in. And that's where the industry has gone. Many of you that are involved with companies, you know, understand that. I mean, you probably had, Reg and I were we're talking, I mean, how many private equity groups have called you over the last year?
Oh, God. I get at least 3 a week.
And they're probably, they're groups that are focused on the markets in which Reg serves. I think you've just got to have a not only for sourcing outbound calling, knowing what companies to call, but underwriting them and then ultimately working with them. I mean, many times for the companies we invest in, even on a buyout for us would be where we buy 70% of the company and we are looking to, for the existing management team to roll over a significant, if not all of their holdings. And even the owner to roll over a portion of the proceeds out of the deal into our deal. They're looking to bring in, as a result, a partner. I mean, it's not a public company selling off a division, highest price, best terms, you buy it. With us, we're coming in, we may be doing a buyout of the company, but we're looking for a significant rollover. And many times that second bite of the apple is important. They want a partner that knows something about the industry, can add value, and ultimately make that a worthwhile investment.
Okay, we've got time for a couple more questions. Before I take them, I'll remind you, everybody who registered, I'll send a list of the registrants by email with their email address, so you have that if you want to reach out and close a circle with somebody that you met. For the 100 Men cards, please take one. On the back there's the website address, there's the email if you want to send me an email. It gives you the kind of the 3 or 4 things that are about it. So let's take 2 more questions. We try to be religious about getting out of here before 9 o'clock. So
Yes.
Chris?
I would say, given the roots of where the fund has come from, started out, and given what Northeast Ohio is trying to do from an early stage technology kind of a standpoint, do you get any pressure at all to say, why don't you take 10% of your fund and create a venture fund, go back to doing the venture kind of funding that Ohio needs? I mean, Third Frontier did a great job, but they're not putting any more money out there in the marketplace as of right now. And you guys have been down that road. Can you help us out?
We haven't had that pressure. Our investor base now is international, and they're, number one, they are very much focused on this strategy that I outlined, this lower middle market growth company. That's why they invested in us. And they represent pension funds and endowments and foundations and like, and they're looking at the best returns possible. So putting any constraint on the fund, they wouldn't do. I acknowledge that venture capital, early stage money is more difficult to secure. But from our perspective, we have not had any pressure, even from the state funds, who are looking at rate of return as the primary ingredient for their interest in a venture fund or private equity. So we have clearly stated what our strategy is. People have invested behind that, so we don't do a carve out. So we're not doing early stage. The venture capital business has matured just like private equity, and I would submit that if Cleveland or Northeast Ohio has a very interesting early stage investment, the capital will find it. Capital moves around, and I'm not saying that having some capital here wouldn't help. I think there is capital available. There are groups drive capital down to Columbus as an example. Allos down in Cincinnati and Indianapolis would be another example. There's some early stage pockets of capital in Cleveland. But it's a multi-billion dollar industry that is venture capital when it wasn't, in 1985. And again, I think if the opportunities are attractive, the companies are attractive, the technology is attractive, finding capital shouldn't be the issue. And there are some local groups that do invest, but we're not doing that.
Just building off Chris's question about Northeast Ohio, switching gears a little bit, can you talk a little bit about the Western Reserve Land Conservancy and what do they do? Why are you involved?
I'll do a little promo here. I've been involved in land conservation work since, I guess, 2000 when I was involved in putting an easement on a piece of property. I don't know of those that know about the group. It's a land conservation group. It's a product of 13 mergers of land trusts in northern Ohio, which is kind of unprecedented nationally. It's one of the largest land trusts in the country now, probably the most sophisticated. When I joined the board, they had protected a little less than 2,000 acres. They've now protected close to 60,000 acres of property, over 700 separate parcels with easements. You drive down River Road, or you can go down into the Buckeye area of Cleveland, you'll see where the Conservancy is at work. It's a great organization. I'm also involved in a national organization called the Land Trust Alliance, which is the membership organization for all land trusts. But we've got a real gem here. I mean, there's organizations that are world class in Cleveland. The Symphony, the Museum, Cleveland Clinic, which I would rank our land trust here and the work that they're doing among those.
Final question? Yes, sir.
What makes you start another fund?
What's that?
What's the significance of the 7 that you have?
What makes us start another fund?
Yes.
Well, full investment of the current fund would be one reason. We raise a fund, we invest it over a 5-year period, and we then, once we're fully invested, we go out and raise another fund from our investors. So we the typical sequence is invest over a 3 to 5 year period. Probably in year 4, begin conversations with our investors. Once we're roughly 70% committed on the existing fund, and tell them that we're in the process. We probably take a year then to get that fund put in place. And when we're fully invested in Primus 7, as an example, we want to have Primus 8 in place, and as soon as we get the full investment, we activate Primus 8, and we'll do the same for Primus 9 once we're fully invested in 8.
Let's take one more question.
Sure.
And would you stick around for a few minutes if people want to chat?
Be happy to.
Okay, go ahead.
Good morning, my name is Gary. Most of us here have lost some money in different ventures. So my question is, what are some of the due diligence checks you do to kind of make sure at the end of the day that your money is more secure, your investment?
And we've lost our share as well. We do a lot of due diligence on the companies we invest in, and when we make the investment, we have the expectation they're all going to be successful and will do well. What do we miss? We may miss. There's a whole bunch of things. It could be, market development. It could be a product issue. It could be a competitive environment that is very different than what we thought. It could be management that got us in trouble. We weren't able to change quick enough. A company that the business model didn't prove out to be what we thought in terms of margins, in terms of growth, in terms of cost related to acquiring customers. All those things are at work, and we do our work. We build out a point of view based on our diligence, and many times that doesn't work out. How do we protect ourselves? If we own the company outright, we're a control investor. It's hard to do it with structure because you own the company. We will attempt to sell it if we think it's not performing, and see if we can't get liquid and move on. In the minority investments, which again represent about 1/3 of the companies we invest in, we can use structure. So we will go in with a senior security with minimum returns, and that allows us in the event of a sideways deal or a deal that's not performing, to at least be at the top of the stack in terms of proceeds in the event of a sale. But there's a thousand reasons why a company won't work. We've probably seen them all. I think the quality of the diligence we do today is different than we did certainly when we started the firm. It was not as well organized. We've got deal teams, we've got resources. We bring to bear accountants, industry experts. Groups that go out and do a marketing check, talk with customers, prospective customers. We have an insurance diligence check. We probably bring, on an average deal, 6 third parties as part of our diligence team. It's a much more sophisticated approach to diligence. The companies we invest in, find it to be difficult. And we may take 60 to 90 days on diligence before we close. Things move along more quickly today in terms of getting from a process that starts to letter of intent to exclusivity. But we haven't compromised the work that we do, and it probably takes 60 to 90 days to complete the work. And hopefully we do it right, but we don't always. And in Primus 7, I don't think we're going to have any company that's where we lose capital or don't get a pretty good return. Primus 8, we've got one company that's valued under cost right now. We're trying to sort out what to do. Some of it's management, some of it is customer churn that we've been trying to deal with. And we're working hard to fix that, and we'll sort out how we ultimately liquidate that investment.
Okay, well, thank you everybody for coming here today. I hope it was enjoyable and you had a good time. Our next meeting, Ray Dalton and Ben will have an interesting discussion. I think it's May 18th. We'll send you a notice. And most importantly, I'd like to thank Bill for being here today.